Welcome back to the channel, everyone. Manny B Investing in BI, and we're going to take a look at a Paribus blog posting from July 12th, Understanding Market Risk. Let's take a look at the tweet. Market risk. Whether it's a bear or bull, markets are continually pricing in risk. This article details the important concept of risk and helps explain this factor of price volatility. Let's take a look. Most people think of free markets from the point of view of supply and demand. Scarcity in its relationship to price is a concept many in the cryptocurrency space are deeply familiar with. However, most people who are new to the space don't have such a clear-cut understanding of how risk is related to price. In general, all markets price in risk, which is why the value of cryptocurrency falls during a risk-off market phase. The bear market, for instance, is a time when risk is considered to be higher, so the price appetite for people to buy in the bull market levels quickly dries up. This means that if people want to sell, they have to lower their prices. A similar thing in the housing market right now. The most recent bull market is driven by a combination of factors such as money printing, which is America's fault, which gave retail investors extra liquidity to invest. So everybody that had those PPP loans, that are balling, that quit their jobs and seem to just be surviving without jobs, that is what they're talking about. And the Bitcoin halving, which in similar ways, the present bear market is also being driven by a variety of factors such as rising inflation, the war in Europe, and the central banks tightening their monetary policies, which is the opposite of what America is doing right now. When conditions such as these arise, investors start to move away from assets with a significant degree of risk. They realize the value of their holdings drop considerably, so they sell and move their liquidity into more stable assets. These are usually government bonds, and as the global reserve currency is the US dollar, the most attractive ones are the US Treasury Bonds. And there's a little thingy of them. In bear markets, investors are looking for low risk. They look to real estate and bonds as a way to ensure their holdings doesn't lose too much value. The outlook isn't based on trying to get a return on their investment. Rather, they are trying to protect the returns they gained in a bull market from being wiped out in a bear market. The current yield rate for a 10-year Treasury bond is a little over 3% APR. When you consider that the inflation rate is around 9%, that would mean holders of a 10-year bond would lose 6% of their assets value per year. From a bull market perspective, this looks like a bad deal, but from a bear market perspective, it's a safe haven. In the last 6 months in 2022, if you held 10-year bonds, you would lose approximately 3% of your total asset value. If you held that same amount in Bitcoin, you would have lost 60% of your asset value. With many altcoins, it's a loss of over 90%. Conversely, during the bull market, had you held a US bond, you would still have lost money, whereas if you held Bitcoin, you would have doubled your asset value. Many people who hold altcoins achieve 10 to 100x increases in their asset values. Looking at markets in this way, it's easier to see how risk is related to price. Risk is always priced into every market, which explains why Bitcoin won't give a 10x return quickly, whereas these altcoins will easily achieve that in the coming months or years. This understanding of the risk is characterized by a famous quote often attributed to the 18th century Baron Rothschild: "Buy when there is blood in the streets, even if the blood is your own." When the market is capitulating, fear is high, risk is also high, which means the prices are low. And then we have the fear and greed index right here. For many people, their first experience of markets is when they enter cryptocurrency. They're often fooled into thinking it's guaranteed returns and easy gains. Being led by emotion, they often buy when prices are high because they think it will continue to go up, and sell when prices are low out of fear for prices falling further. To survive this roller coaster of volatility, it's often recommended that people zoom out and take a longer term view. For those that are still here, this may be their first experience in market cycles. Prices are low now because it's a risk-off environment with liquidity flowing to low-risk assets. That dynamic won't remain because people want to make money from the markets. As soon as the prevailing winds change, money will flow back into higher risk assets such as cryptocurrency. And just as the value of risk assets fall more dramatically in fearful times, they also increase exponentially when money flows back in. Although it's easier said than done, we prefer to focus on development rather than price fluctuations. At times like these, we can make real headway in the building of the next phase of the cycle. So very interesting little short article on understanding market risk, how prices are priced into markets, and the reasons why everything's so cheap now, but not very long ago, everything was super expensive, and how you are supposed to, not financial advice, ride those waves. Buy when it's low, sell when it's high, and then get into a stable asset. When that prices drop again, you buy when it's low, sell when it's high, and move that money to stable assets. And that's how people, and that's how families like the Rothschilds continue to get rich, 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 and rich. And this is hopefully how you and I are going to do the same thing. So thank you again for checking out the video. Hit that like, hit that share, subscribe, and we'll see you on the next one. Peace.